Hi dear traders! Market participants are increasing speculation that the Federal Reserve might slow down the pace of rate hikes. At the same time, investors are certain that the European monetary authorities are taking over-aggressive monetary tightening from the US Central Bank. Besides, among the European currencies, the pound sterling found support because Rishi Sunak took office as the new British Prime Minister. Now let's discuss how trading sentiment might change in the currency market in the last 2 days of the trading week. A slew of macroeconomic data from the Eurozone proves a recession threat. The consumption activity is viewed as a barometer of the Eurozone service sector, the key economic sector. Recent reports have been logging a decline in consumption. The value of the Consumer Sentiment Index in Germany has plummeted to a historic low as a result of soaring inflation and an incredible rally in energy prices. In turn, consumers are suffering huge losses in their real incomes. On top of that, high interest rates do not encourage purchasing activity. The highly anticipated event this week is the ECB's regular policy meeting. The regulator is widely expected to raise the key interest rate by another 75 basis points. In consequence, the interest rate will stand at its highest level since early 2009. Apparently, the sharp rate hike will hardly push inflation down. Besides, this ECB decision has already been priced in by the market. Therefore, investors will shift focus towards the ECB rhetoric and the agenda for further policy moves. If the regulator signals another rate hike at the same pace, such prospects will be bullish for the single European currency. It might happen that traders will give priority to the news from the US. On Thursday, the US Department of Commerce is due to report the flash estimate for gross domestic products for the third quarter. The market consensus suggests some signs of recovery in the US economy in July to September quarter. The national economic output could have expanded by 2.3% sequentially, which means the exit from the technical recession. It's unclear how the market will respond to the news. Obviously, the positive value provides the Federal Reserve with leverage to go ahead with its aggressive fight against high inflation. In this context, the US dollar is likely to continue its advance across the board. The greenback is sure to assert its strength against the Japanese yen. Despite forex interventions by the Bank of Japan, the yen has been still pinned at the lowest level in the last 32 years for the simple reason that the American and Japanese central banks pursue polar opposite monetary policies. While the Federal Reserve raises interest rates at a fast pace, the Bank of Japan maintains the key policy rate on negative territory. The Japanese regulator is holding the next policy meeting on October 28. The policymakers will hardly introduce any changes to the current rhetoric. Following the policy decisions, traders will have an excuse to sell the yen. On Thursday, market participants will find fresh evidence of a striking difference between the US and German economies. Whereas analysts foresee signs that the US economy exited a recession, the German economy is projected to shrink in the third quarter. Both reports will provide preliminary data. In a separate report, inflation in Germany is unlikely to loosen its grip. In the first estimate, the Germany's annual CPI could have accelerated 10.1% in October. It will assure the ECB to take drastic measures. However, the single European currency will hardly receive support from such news. Indeed, market participants will be alert to a report on US personal spending. Investors hope to receive new evidence of recovery in the US economy. Despite inflated energy prices and high borrowing costs, the consumer activity is showing resilience. Importantly, 2/3 of the US GDP is generated by consumer spending. For this reason, the US personal spending report will be high on agenda on Friday. These events will be in the limelight among investors in the second half of this trading week. Don't miss our daily news reports to be always in touch with the latest events. Stay tuned.